Hello, everybody. Thank you for joining us for today's public webinar. Jim just got back from vacation, so good morning, Jim. Glad to have you
Good
back.
morning. Good morning. Good morning. I've been on the Snake River, watching a very interesting territory. Saw some beautiful eagles. Saw some bighorn sheep. Saw some little baby bighorn sheep. They were no more than 3 to 7 days old. Very interesting trip. Anyhow, let's start off, and I've got a little bit of something for everyone, I think, in here this morning. First of all, when I prepare for the day, I always start from a kind of a bigger picture to have an understanding of what's going on in the market overall, at least from my opinion. But then what I have to do is work from a top-down approach so that when I get done, I'm prepared for short-term trader. I'm a short-term trader. If I take anything home overnight, it will always be hedged. Now, a hedge could be a long option. I consider that a hedge. But let me start from where I am on a bigger picture basis. And part of the problem that you face when you take a bigger picture basis is that you have to be careful that it doesn't feed a short-term bias. My bigger perspective on this market is not one that's commonly shared by many folks out there. But I think there's a possibility that the market is setting itself up to go back to an era that we saw in the early 70s. And that was an era of what we call stagflation. Stagflation is a situation where you have continued inflation, and at the same time, you have increasing unemployment. To support that, I've been on this view for some period of time. But if you take a look at yesterday's jobs report, the weekly jobs report, I think it was the highest number that we've had in some period of time. That is consistent with a market that is showing stagflation. Now, that can really, like I said, that can really mess you up as a short-term trader. But I like to start and have, some perspective of what's going on out there. The second perspective that I share with you, and this becomes really relevant. There's an awful lot of short-term traders that will look at, say, the NASDAQ, for example, to trade the ES. And they build that habit. Well, that habit would have hurt you pretty badly yesterday, because it was, the NASDAQ never got outside of the previous day's range. But I think the market we're dealing with here now is a market that you don't see too often. I've seen them before, but it's what I call kind of a rolling market. And they're tricky markets to trade unless you really do appreciate what's going on. And by a rolling market, what I mean is the market, if you notice that for a long time, all the focus was on the NASDAQ and, the big tech stocks. Well, the big tech stocks, really haven't been, that active in this market. But the market's rolled. One of the things that will keep a market strong is it will roll from one group or one sector to another. And basically what it looks to me, what happened, we rolled over from big tech, and now we're in the point where you're getting some of the value stocks that, weren't in favor and didn't have much interest. And now it looks like the market's rolled and they didn't have see much in the other end of the market, so they now rolled down to value. That can be a very difficult market if you don't understand what's going on. So again, that's where I start, just to have a perspective of what I think is going on in the market overall. Next, I look back and I say, okay, I look at, and I'm going to go to my charts for just a second here. And I look and I say, okay, as I'm working from a top-down approach, and I'll see, here's the 100-day. The market came almost exactly off the 100-day. Yesterday, you can see the day before, right off the 50-day. So when I see this, it's just another sign to me that it's an awful lot of very short-term traders following the very mechanical references in the market. Okay, now before I go and get a little bit more specific on something I think was very important for yesterday, let's do our commercial. As you know, we do these programs in order to continue to draw attention to our educational efforts. The next program we've got coming up, what is the start date for the intensive? Is it June 8th?
June 3rd through the 28th.
June
So
3rd.
I'll just fill on my screen here real quick. I'll take the screen real quick.
No, not yet.
Oh, I'm sorry. I already took it because.
Oh, okay. Well, let me just talk.
Okay. During the commercial.
The intensive is our master program. It goes about 4.5 weeks, but there's a prerequisite. To attend the intensive, you have to have either attended a prior intensive or have been had taken the foundational eCourse. And the reason for that is that several people have attended a lot of intensives, and we don't really take time to answer basic questions in that program. But one of the things, and before we go to that, let me just show you some of the things that we talk about.
I'll give you the screen back, Jim.
Please. Yeah. Before we do a fuller commercial, Jen, would you put up the chart, the one graph I sent you yesterday, please?
Oh, sure. Yeah, I have that. 1 second. Okay, you want me to take the screen back to show it?
Please.
Okay. There you go.
Okay, so I sent this to Jen yesterday morning, and I wanted to use it to talk about it today. And what we're talking about in here is what I call market-generated information. So many times, traders have biases. I get biases, you get biases. And the question is, can you overcome those biases? And to overcome those biases, the best way is to look at market-generated information. And here is just an example of what it is. If you take a look at the day on your left, at the 7th, there is no excess on the high. Excess marks the end of one auction, the beginning of another auction. So while the market went up and it faded in I period, and that was, the end of that day. Then you come down, and on the 8th, you had no excess again. So when you see these excess, it tells me there's no completion to the upward auction. And that doesn't mean you don't get liquidation. It doesn't mean that the market didn't get, too long. So much of short-term trading is that inventory gets too long, and then you get liquidation in order to bring that inventory back into balance. But the fact that you have 2 back-to-back days with no excess tells me that there's no, when I look at market-generated information, it tells me there's no completion to the current auction. The odds are, first of all, the odds of being short are terribly against you because there's no completion. Remember, they're only odds, not absolutes. But the odds favor a market that's going to trade higher and take out those highs. Now, keep in mind, these were sent early yesterday. And as you can see what the market did, you got some sell-off early in the morning, but there was no downside follow through. And some people got tricked because you had a much sharper sell-off in the NASDAQ in there than you did in the ES. So it's important to be able to look at each individual market. No excess, so there's no completion to the current short-term auction, and the odds are very high based on market-generated information that those are going to be taken out. And as you can see, that's exactly what happened yesterday. So I'm just using that as an example of what is market-generated information, what is the importance of it, and how does it help you? It helps you understand what you don't want to do, and the odds of going short the market were against you. That doesn't mean it won't work, because you made a little bit the day before, but the odds were that the market would trade higher, which is what it did yesterday. Okay, that's market generated information. That's a real life example of it. Jen, let's go back, and why don't you complete the commercial, then we'll come back and look more closely at the current market.
Okay. So for those of you that are new, I just want to give you just a quick overview of our website where you can find things. We do a week ahead video on YouTube every week. So to find that and to subscribe to that, you can go to our webpage at jimdeltontrading.com. And then our X account is here as well. But as you heard Jim say earlier, we've got the live intensive running from June 3rd to 28th. Currently, we've got limited time discounted bundles, so you get a nice discount for purchasing more than one course. And if you don't have that prerequisite requirement of the foundation and application of the market profile eCourse, then it would be appropriate to get the bundle right here. We also have other bundles as well, what we call our triple bundle, that also has the advanced nuances eCourse. And then if you're somebody who's already joined us for an intensive before and are qualified to be in an intensive, then if you haven't gotten the advanced nuances eCourse and you'd like to do that in the intensive, we've got that here discounted as well. And for those of you familiar, our eCourses rarely go on sale. Usually we only have them on sale when we are marketing for an intensive, and we bundle them in these bundles. And so basically we are starting to run out of time in terms of for you to have enough time to have the foundation eCourse completed. So probably in another less than 2 weeks or something around that time frame, we will not have the bundles available anymore, because we know it's not realistic for somebody to get the foundation eCourse finished in time. But anyhow, if you have any questions on what's right for you, or any questions about any of our courses, please contact us. Shoot us an email at dalton@jimdeltontrading.com, or give us a call, and I'd be happy to speak with you. Okay, I'll give you the screen back, Jim.
Thank you.
Oh, and I just also want to mention for everybody that all of the, I've given you the screen back, Jim. All of the webinars, live webinars, are recorded. So if you live in a time zone or you've got a day job for which you can't attend all of the sessions live, that's not a problem. When you purchase the intensive, you get access to the materials for a year after it's finished, so that you have time to go and review everything. Okay? Okay.
All right, as we prepare for today, overnight, there's a settle, which also is the exact low from overnight. Overnight inventory is 100% long. Early in the night, overnight inventory was long, but it was holding pretty close to this, up to the 52.45 level. And then you had some positive growth numbers come out of Europe, and that got the market, that started the market on the long side. Overnight inventory is, the odds are very high that overnight inventory will lead to a counter auction. So a counter auction, if overnight inventory is long, the counter auction would be selling. If you don't get a counter auction, that is usually a sign that there's strength, at least for the day time frame. So that's the first thing I'm looking for this morning, is overnight inventory is long. The market's going to open in about 15 minutes. The odds favor a counter auction. Counter auction would be selling. If all of the overnight trade is taken out, that we do trade down below this, then your focus shifts to focusing on developing value. Okay, so that's just the start. The odds favor a very high percentage that you're going to get a counter auction, which would be a correction to overnight inventory. You can get a full correction or a partial correction. Right now, the market backed off, and you can see they bought it right at half back from overnight. So the white line is the half back. So again, it was very mechanical, weaker hands buying in there. Okay. The market over, this is what we're looking for. If the market does take out the overnight low, then our focus shifts to developing value. Now, yesterday, as you can see, value, which is the blue area, value was higher all day long. And that is what we trade, value, not price. Price is an advertising mechanism. The real focus is on value. Okay, now, yesterday's volume overall, and we use NYSE volume as a proxy. There's not a real good way to get a handle on volume, but we use it as a proxy. So volume overall was weak. The matching L&M lows suggest that it was weak momentum buying late in the day, low odds of continuation. Okay, let's open up for some questions.
Okay, here's a question that somebody had sent. When Jim says that excess and balance are the two most important things, does he mean imbalance when he uses the word excess?
I'm sorry, I don't understand the question. Excess is, this is excess. If there's single prints, it's excess. I don't understand the question. Balance is mean, a couple overlapping days or multiple days. Excess is when you got a market that looked above or below and left single prints. Okay, what else?
Okay, Jim, did you consider taking a long option overnight as a hedged position? Just to be clear, it's just the long option with no futures also open against it?
I actually went home long some futures and long a couple of puts. So it was a hedged position, very small hedge position, just because the momentum is higher. But that's all. It's a very minor position. What else? Another thing you could look at this morning, I've talked about the overnight inventory, and of course you have a very prominent point of control. The more prominent an overnight point of control is, the greater the odds that it will be revisited. Now, remember, the momentum is up. Momentum is trading is up, but the market overall is weak, but the momentum is up. All I've basically seen in here is, a lot of short-term traders, and as I said, the market, it's a rolling market, meaning that, we've rolled from where the market was focusing on the high tech, and then it's now rolled and it's looking more at the value stocks and dividend payers. But the other thing you could look at this morning is a gap. So we have the gap trading guidelines, and there's multiple gaps in the last few days, which is usually a sign that the market is getting very enthusiastic. Here's you've got the market down here, you've got a gap, you've got another gap, I think, down here. It's just been a very positive market for particularly short-term traders and momentum. So the gap trading guidelines are go with all gaps that aren't filled fairly quickly. And I can't perfectly define fairly quickly, but the market will gap higher. We've got about 8 minutes till we open. The buying opportunity on a market that gaps higher is an attempt to fill the gap where both volume and tempo slow as the market is trading off. If the gap is filled, then your focus shifts to developing value. And if value doesn't develop to at least overlapping to yesterday, the odds of a later rally increase substantially. Okay, other questions?
Yes. Okay. Would Jim ever use the S&P futures volume as an indicator instead of the NYSE?
No, I don't. Now, if you look, I keep the volume right here, closest to the profile is the half-hour volume. The volume on the left is the total futures volume. What I use this volume for is to have a better idea of what's going on in the current half-hour period. White volume is the lightest, pink is in the middle, and red is the heaviest. I use it a lot of times. What you'll see where this comes in handy, you'll see a market break, and it'll break very sharply, but you'll see that the volume is white, very light volume, and a lot of times that means the market's going to work its way back up pretty quickly. If you get a break and you get some pink or red volume in there, that's usually an indication that there's something more serious. But no, overall, I don't live and die by the volume because it's so hard to get a real picture of it. I look more at shape. For example, yesterday, I didn't particularly like yesterday's market. There was very mechanical buying, which told me it was mostly short-term momentum buyers. But I don't fight value. Value is 70% of the day. And if you learn to focus on value, it will go a long way towards keeping you balanced perspective throughout the day. Okay, what else we got?
Okay. Does the narrow lower gap along with 100% overnight inventory typically increase the odds of a correction of overnight inventory to the downside?
I don't know the answer. It's not something I've really studied. I don't do a lot of that. I mean, I look to see overall what the odds are, and I've looked at it over the years. I've had some people check it out and say we're right on. But the basic thing is, I'm a short-term trader for the most part. And the most part, I say overnight inventory is long. So what is the information? If overnight inventory is long, and I know the odds are that you get a counter auction and you get corrected and it doesn't correct, that's a sign that we've got some short-term strength in the market today. That's the market generated information that is most relevant to me. I look and I say, okay, as this market sold off, it sold off exactly the half back or one tick below it. It's an indication to me that it's probably pretty weak hands buying in here. So the odds of getting a little bit more aggressive counter auction are higher. If you do get the counter auction, the more prominent the overnight point of control is, the greater the odds that will be revisited. Now, we've been a little short on information. You have one piece of information comes out at 10 o'clock this morning. It's not a huge piece, but that's the next piece of economic news. Okay, what else?
Okay. Which time frame is responsible for gaps, long-term or short-term?
There was no answer to that question. Now, one of the reasons that, one of the reasons I look to see is a gap is filled. If a gap is filled, then the odds are pretty good that the gap was created by shorter time frames. If the gap is not filled, then the odds are increased that there was a little longer time frame involvement in the market. Now, when I look, recently the volume has been so low. For example, yesterday we had a big up day yesterday. Volume was a couple percentage points below the previous day, and it didn't even get to the 4 billion mark. So again, there's no answer to those questions. You have to take a deeper look and say what's really going on in the market. Okay.
Okay. Aside from stagflation, what risks do you see as prominent to where we are in the market cycle?
Well, I think that I think short-term inventory is very long in this market, but I think that it's very lethargic out there. You don't have any indication that the long-term time frame doesn't really seem to be active in the market. They've been long for a long period of time. Yeah, they may switch, some industries now and then, but the risk is all of a sudden the market starts to sell off and they start to get nervous and come in. Usually the markets have shown quite a bit of weakness before you get selling by the long time frame. If they sold, early, they probably wouldn't be long time frame in there. So they have a tendency, the market will be off 7 to 9% or so before they come in. And a lot of times you see the market will be off 9 or 10%. They don't come in and then you get buying. So again, you always have to be alert to what is going on right now in the present tense. Okay, final question.
How do you quantify a top-down approach? For instance, when the monthly is pulling back, weekly is trending up, and the daily is pulling back?
You just look realistic and, you say, okay, the monthly is an inside bar. Okay, so what is an inside bar? The market's coming into the short-term balance. It's ceased one time framing. Markets, when you've got the market's been going up as long as this market's been going up, it takes a lot. It takes a lot. It usually takes some kind of catalyst to break the market. Some kind of shock, some kind of wake-up call. But it's overall, it doesn't look very strong. Overall, there's some signs of weakness in here, but the selling's not there. And if you want to go broke, jump the gun and sell too early. Many times, you're better off to be a little bit late rather than early in the market. Okay. Final question.
Oh, yes. Is the volume display on the left-hand side of Window Trader essentially a volume profile, or would you read it as a type of volume profile?
No, it's just the actual volume.
I can show my screen. 1 second, Jim.
Yeah.
I got it here. Okay.
Okay, so we got the market open, and remember that the first downward reference would be half back from overnight in there, and we see you're starting to get a little counter auction, and now you see how extensive it gets. All right, let me say thank you very much. I hope you consider joining us for one of our programs. Thanks.
Thank you, and have a great weekend, everybody. See you next time. Bye.